Welcome back to the deep dive. Last time we looked into Q3 FY 2025 for companies like Sports Toto, and you might remember some bits really stood out, didn't they?
Yeah, especially at their gaming side and that UK automotive business, Owen. They showed some, well, surprising strength back then.
Okay, let's unpack this then. Seeing those bright spots in Q3, it makes you wonder, right, was that just a blip? Or a real shift? What's actually happening at the subsidiary level now? So that's our mission today. A full deep dive into Sports Toto Berhad, or SPTOTO, looking specifically at their Q4 and the full year FY 2025 performance.
Precisely. Today, we're aiming to cut through the noise. We'll use the latest reports to give you the clearest possible picture of SPTO2. We'll examine its valuation, what the future might hold. For this company known mainly for its number forecaster operations, the NFO business via STM Lottery. And like you said, it's a UK luxury car dealership, Owen.
Right. And just for context, crucial context, actually, as of today, September 11th, SP2O's share price is sitting at RM1.42. Before we really dive in, just a quick reminder, please hit that like button, drop us a comment, and subscribe to the YouTube channel. It genuinely helps us bring you more deep dives like this one. Q4 FY 2025 performance, a shift in momentum. So we just mentioned that, well, surprisingly strong Q3 FY 2025 for SPTO2, but here's where it gets really interesting and maybe a bit concerning, frankly. How did Q4 actually shape up, especially comparing it to that strong previous quarter and, the same time last year? Did the momentum hold? Or did we get an unexpected plot twist?
Well, Q4 FY 2025 definitely delivered a significant plot twist, and not necessarily a good one. While the group revenue only saw a marginal drop, about 1.3% year-on-year, the real story, the alarming part, was the plunge in profitability. Group profit before tax, PBT, that dropped by a pretty significant 30.6% compared to Q4 last year.
30%? Wow.
Yeah. And if you look at the core profit, it fell even more sharply, a staggering 40.3% year-on-year. So this wasn't just a minor dip. It was a clear signal of deeper issues, mainly softer sales from Owen and higher investment-related costs across the group.
Wow, a 40% dive in core profit after a strong Q3. That's a serious hit. Okay, so if the overall group was down that much, what about the specifics? The NFO segment, STM Lottery in Q4, was it part of the problem or still holding up?
The NFO segment, it was kind of a mixed bag, actually. Revenues showed strong growth, 3.7% year-on-year, which is positive. That was mainly driven by, those higher accumulator prizes from the 4D jackpot game. The number of draws stayed the same.
Okay.
But despite that revenue growth, NFO's PBT actually decreased by nearly 15%.
15? Why?
Higher operating expenses, including some significant corporate social responsibility, or CSR, sponsorships. So that meant the NFO's segmental margin took a noticeable hit. It dropped from 15.7% in Q3 down to 11.7% in Q4.
Okay, so NFO revenue up, but profit down because costs went up. That's a curious dynamic, especially for their main business. What about Owen then? Was that the main driver behind the group's big profit drop?
Owen certainly played a part, yes. Its Q4 revenue fell 4.1% year-on-year. This was largely down to lower new car sales volumes. Seems it was affected by changes in manufacturer distribution structures, maybe some models nearing the end of their life cycle.
Right.
And more critically, Owen's PBT. It declined sharply, 34.5% quarter-on-quarter. That lines up with the lower revenue and also increased operating expenses from brand positioning efforts. Its segmental margin also fell from 2.7% in Q3 to just 1.8% in Q4. That really shows how sensitive that segment is to market shifts and, operational costs. So stepping back, after a surprisingly strong Q3 that maybe hinted at momentum, Q4 delivered a sharp, significant plunge in group profitability. That's a critical red flag, really. It signals those positive trends from Q3 just didn't hold. 2, full year FY 2025 performance and trends.
That Q4 slump sounds pretty dramatic, yeah. So what does this all mean for the entire financial year? Ending June 2025, did that strong Q3 performance carry enough weight to balance out the Q4 dip? Or did Q4 drag the whole year down?
For the full financial year, FY 2025, the picture is actually more resilient, but, still with nuances. Group revenue, it increased a modest 1.7% to RM 6.46 billion compared to FY 2024, and group PBT saw a healthier 8.2% increase. Core net profit also showed solid year-on-year growth, somewhere between, say, 7.5% and 12.4%, depending on which analyst report you look at and their adjustments.
Okay.
So yes, that strong Q3 did help lift the full-year numbers. It basically saved the overall annual performance from Q4's big impact.
Well, that's better than Q4 looked, for sure. So who's the hero and who is maybe the villain in the full year story? Can you break down that annual performance by segment?
Absolutely. The NFO segment, STM Lottery, was definitely the hero here. Its full-year FY2025 revenue grew by a robust 5.4%. And that's despite having fewer draws than the previous year.
Fewer draws, but more revenue.
The key driver was a much higher accumulated Supreme Toto 658 jackpot prize. That really boosted sales per draw significantly. So as a result, NFO PBT increased by a solid 13.1% year-on-year. Also helped by a lower prize payout ratio, actually. Their revenue per draw improved, and importantly, their segmental margin actually improved too to 13.9%.
Okay, so NFO was the star.
Pretty much. Now, Owen, on the other hand, it faced continued headwinds. While its revenue did increase in local UK currency, the unfavorable foreign exchange effects meant it actually showed a slight drop when translated back to Malaysian ringgit.
Ah, the currency effect.
Exactly. And more importantly, its PBT declined significantly, by 25.2% year-on-year. This was mainly due to those elevated operating expenses, brand positioning, and high general operating costs. Even though they got some relief from lower finance costs, its segmental margin declined to just 1.0%.
Right, so what's fascinating here is the NFO segment, fueled by those, well, unpredictable jackpot cycles, it clearly carried the profitability for the group in FY2025. Owen, even though it's in the luxury market, just continued to be really sensitive to operational costs, currency swings, making it the segment facing the real challenges this year.
That sums it up well. 3. Financial ratios, valuation, and analyst consensus.
Let's zoom out a bit. Talk about the bigger picture financials beyond just profit. How do the key ratios look, and what's the market actually saying about SPTOTO's current value? You mentioned RM 1.42 today. Are we looking at an undervalued gem here, or is it, fairly priced?
Well, looking at the group's financial health, there are some definite positive trends. For instance, their net debt-to-equity ratio. It shows a strong deleveraging trend. Is projected to decrease significantly in FY2025 and even further by FY2027.
So they're paying down debt.
Exactly. Steadily reducing their debt load. That's a big plus for financial stability. And return on equity, ROE, basically how much profit they make from shareholder money. That's forecasted at a healthy range, around 19.6% to 21.7% for FY2025.
Okay, those sound good. Any mixed signals?
Yeah, there are some things to note. While overall cash generation from operations is still substantial, the net cash generated from operating activities for the full FY 2025 actually decreased compared to FY 2024.
Decreased? Why would that be?
It could signal some pressure on working capital, or perhaps just reflects those higher operational expenses we talked about. It's something to keep an eye on.
Got it. So given all this, back to the valuation. At RM 1.42 today, is it a bargain or priced about right, according to the analysts? What's the consensus?
The consensus seems to lean largely towards fairly valued or maybe just hold. RHB, for example, they see the stock as fairly valued, kind of near the higher end of its historical valuation range based on PE. And the average target price from analysts, it's hovering around RM 1.50. That only implies, maybe 5–6% upside from the current RM 1.42. That usually aligns with a hold call.
Right. It's mostly hold. Any outliers?
Well, yeah, there are always some differences. TA Securities is more optimistic. They have a buy recommendation and a higher target price, RM 1.71, suggesting more significant upside, maybe over 20%.
Interesting.
But, if we connect this back to the bigger picture, the majority of analysts actually expect a decline in net profit for FY 2026. About 6.7% down. And that forecasted dip in future earnings, that's a pretty significant factor behind those cautious hold ratings. It tempers any real excitement about it being, a super undervalued gem right now, a 5E, dividend policy and sustainability.
Okay, let's talk dividends. I know a lot of our listeners are always interested in that. What's the story here? Especially considering those Q4 results and the full year picture. Has the payout been steady, or are there changes we should be aware of?
The dividend picture definitely shows some significant shifts this year. The total dividend per share, DPS, for FY 2025 came in at 8 cents.
8 cents? Wasn't it higher before?
Exactly. It's a noticeable decrease from 10 cents in FY 2024. And, maybe more importantly, the payout ratio for FY 2025. It dropped significantly, down to 45.0% from over 61% last year.
45%? That's quite a drop from 61%.
It is. And it's pretty clear signal from management. Could be they're taking a more conservative approach with cash, or maybe there were potential concerns about immediate earning sustainability that prompted it.
That's a noticeable cut in both DPS and the payout ratio. So what do analysts project for the future? Is this just a temporary dip, or could it be a new trend setting in?
Analysts are actually forecasting a recovery in the dividends for the coming years. They project DPS to increase maybe back to 8.10 cent for FY2026, and then further to 10.11 cent for FY2027.
Okay, so recovery is expected.
Yeah, which would mean the dividend yield also increases.
Yeah.
And the payout ratio, that's expected to bounce back substantially too, rising to nearly 70% in FY2026, and maybe over 70% by FY2027. So it suggests that while, yes, there was a dip this year, analysts seem to believe management is committed to returning more value to shareholders again in the near future.
Right.
But it does raise an important question, doesn't it? While a recovery is forecasted, this year's significant reduction in both DPS and the payout ratio, it definitely serves as a bit of a red flag. It makes you wonder if management is signaling a more conservative stance long term, or if there were genuine concerns about earnings that forced this, let's say, temporary cut. V economic moat. Strengths and weaknesses.
Right. Let's shift gears a bit. Every strong company has its competitive advantages, right? Its moat, those things that protect it from competitors. How strong is SPOTO's moat, and what are the biggest forces trying to, get across it? What makes them unique? But also, what are their biggest vulnerabilities?
Well, one analyst assigns SPTOTO a financial moat score of 6 out of 10, which, was just a moderate advantage, but certainly not impenetrable. Their strengths, they include the license monopoly or maybe oligopoly in the NFO sector. That creates really high barriers to entry.
Sure, the license is key.
Definitely. And management seems confident they can keep their market share lead. Then there's the jackpot factor. That's a huge draw. Big jackpots like that Supreme Toto 658 we mentioned, they really drive customer demand and loyalty. The company also generates pretty robust operating cash flow, and they have that clear strategy to reduce debt, which helps. And of course, H.R. Owen's portfolio of luxury brands gives them a niche advantage too.
Okay, a 6 out of 10. That implies they have some pretty serious challenges trying to erode that moat. What are the biggest weaknesses? Especially for their core NFO business there in Malaysia.
Okay, the single biggest weakness, by far, is the massive illegal gaming market.
Ah, yes, the illegal operators. How big is it?
It's estimated to be, get this, 2 to 3 times the size of the legal market, potentially a staggering RM9 billion annually.
9 billion ringgit. Wow.
Yeah. It's a huge leakage of potential revenue from legal operators like SPTOTO.
Yeah.
Then you have regulatory risks, the closure of legal NFO outlets in states like KEDA and Perlis. Well, that can unfortunately just lead to an explosion of illegal operators filling the gap in those areas.
Yeah, unintended consequences.
Exactly. And then there's just the inherent volatility of the luck factor. Jackpot cycles are unpredictable. They're not guaranteed to repeat, which makes NFO earnings less consistent year to year. For H.R. Owen, it's still macroeconomic and foreign exchange volatility. UK consumer sentiment, inflation, currency rates, they all hit performance. Plus, those high operating costs and depreciation continue to squeeze their margins. And finally, the social context in Malaysia makes legalizing online bowling, tricky. That limits SPTO's ability to adapt fully to digital trends, which, again, could potentially allow illegal online betting to flourish even more.
That RM9 billion figure for illegal gaming is truly sobering. It really highlights this constant uphill battle the legal operators face. Just protecting their existing market must be tough, especially when regulatory changes can shrink their physical footprint.
It's a major, major headwind. Management and direction. Navigating tough times.
Okay, so given all these factors, that Q4 dip, the strong NFO performance, but also the H.R. Owen challenges, the illegal betting threat, how is management navigating these tough times? What's their vision for the next few years? Are they just playing defense, or are they actively trying to find new opportunities to grow?
Management's stance is described as cautiously optimistic. They seem to believe the business will stay stable and resilient, even with global headwinds. They're confident about holding on to their NFO market share lead, and they're actively strengthening the balance sheet, continuing that deleveraging push we talked about. They're also emphasizing robust operating cash flow and a commitment to shareholder returns, hence those forecasts for higher dividends and payout ratios down the line. And they've integrated ESG factors too, aiming for responsible gaming, social initiatives, things like that.
Okay, so a steady hand. What about specifics? For NFO, dealing with illegal betting. For H.R. Owen, managing costs.
Right. For NFO, they're focused on leveraging that jackpot popularity. They expect continued upward trajectory of per-draw sales growth. To combat illegal gaming, they say they're committed to developing sustainable business models within the legislative guidelines. Analysts, meanwhile, are basically saying stricter enforcement is needed from the authorities.
Makes sense.
Management is also engaging with regulators. They're hopeful, apparently, to secure more than 8 special draws for 2026. More draws would directly boost revenue opportunities.
Okay. And HR Owen.
For HR Owen, they anticipate things improving as the global market adapts to new tariffs in 2026. They're also implementing cost management strategies, like they're using internal funds for UK land acquisitions, hoping to reduce those high lease payments over time. And of course, constantly managing foreign exchange exposure is a priority, given how it's impacted them before.
It sounds like a multi-pronged approach then, focusing on financial resilience, adapting to the market where they can, and that crucial regulatory engagement piece to try and strengthen the core business and, well, mitigate those persistent risks. But can cautiously optimistic really win against that massive RM9 billion illegal market? That seems like the elephant in the room.
That's the core challenge, absolutely. The strategies are clear on paper, but the efficacy of combating illegal betting plus managing those broader economic headwinds, that remains crucial for their optimism to actually translate into tangible results. 7. Challenges, risks, and red flags.
Okay, let's try and consolidate the main challenges and risks, and maybe explicitly flag any potential red flags for our listeners so they know exactly what to watch out for.
Sure. So at the group level, key challenges are those global economic headwinds, maybe a lack of obvious near-term catalyst for the share price, given that fairly valued consensus. And importantly, that analyst consensus forecasting a net profit decline for FY2026, for NFO specifically. It's that massive RM9 billion illegal gaming market. It's regulatory risks like outlet closures, potentially boosting illegal players. It's the volatility of the luck factor, the jackpots, and the potential for fewer special draw days in the future. All significant threats.
Right, and HR Owen.
HR Owen faces those macroeconomic and forex volatilities, tariff threats, supply chain dynamics, high operating costs. And remember, they also have that notable contingent liability, that customs duty and VAT reassessment from HMRC in the UK. About RM 12.3 million equivalent. It's under appeal, but it's still a risk hanging out there.
Okay, now let's pinpoint those potential red flags. The specific indicators from the recent results that should really grab an investor's attention.
Right. The first major red flag, I'd say, is that sharp decline in Q4 FY2025 profitability. Core profit plunging over 61% quarter-on-quarter and over 40% year-on-year. That shows real sensitivity to operational factors. Second, the group recognized significant impairment charges this financial year. A big chunk came in Q4 alone, linked to an associated company receivable. That might suggest some potential asset quality issues somewhere.
Okay. What else?
Third, that reduced dividend payout is a clear concern. Total DPS down for FY2025, and the payout ratio significantly decreased. That's a signal. Fourth, the high effective tax rate in Q4, apparently due to disallowed expenses and separate tax assessments. If that persists, it consistently reduces net profit. And finally, remember that full FY2025 net cash generated from operating activities actually decreased from FY2024. Despite overall revenue growth, that signals maybe less efficient working capital management or just higher operational cash outflows. These are all worth watching very closely.
That's a pretty comprehensive list of concerns for investors to chew on. It definitely sounds like management has its work cut out navigating these issues effectively.
They certainly do. Eighth, top 5 catalysts for next 2 years.
Okay, despite all these challenges and the red flags we just listed, every company has potential drivers for future growth, right? Catalysts. So what would you say are the top 5 catalysts for SPTC over the next, say, 2 years? Things that could really turn the tide and drive performance.
Okay, top 5 potential catalysts. First, continued strong NFO performance, especially if they get favorable jackpot cycles and those per-draw sales stay high. For instance, there was a recent big Supreme 658 jackpot, RM 78.5 million, cleared on August 20th, 2025. That's already expected to give Q1 FY 2026 results a nice boost.
The jackpot effect again.
Exactly. Second catalyst, we could see an improvement in HR Owen's operations, maybe as the global market adapts to those new tariffs in 2026. Plus, maybe a modest list from the upcoming September car plate campaign in the UK. Third, the potential for an increased number of special draws for NFO. Remember, management is hopeful to get more than 8 special draws for 2026. That would directly boost revenue.
Right, that would be significant.
Fourth, strategic cost reduction for HR Owen, specifically through those UK land acquisitions they're funding internally. That's anticipated to reduce those high lease payments over time. And fifth, that forecasted recovery and growth in dividend payouts. Analysts projecting DPS to increase and the payout ratio rising back towards maybe over 70% by FY 2027. That signals enhanced shareholder returns, which could attract investors.
Okay, so it's clear there are specific levers management is trying to pull, focusing on both segments and definitely keeping an eye on shareholder returns. Financial scorecard in comparison to previous deep dive. All right, let's try to bring it all together now. Let's give SPTOO a financial scorecard, maybe 1 to 10. And importantly, let's see how this full picture compares to our earlier observations from that Q3 deep dive we did.
Okay, based on everything we've discussed, our overall assessment for Sports Toto Berhad, the financial scorecard, lands at a 6 out of 10.
6 out of 10, okay. Why 6?
Well, it's fundamentally stable. It has clear strengths, particularly in NFO. But those substantial challenges and risks we've covered really temper its potential. So 6 feels about right, solid, but facing headwinds.
Got it. Can we break that 6 down? How does it score in different areas?
Sure. Let's start with profitability. That gets a 5 out of 10. While NFO PBT grew strongly for the full year, that sharp plunge in Q4 profitability is a major concern. Remember how our previous deep dive highlighted a surprisingly strong Q3?
Yeah, I remember.
Well, this 510 score really reflects that later Q4 volatility. It shows the full year picture wasn't quite as rosy as Q3 alone suggested.
Okay. What about efficiency?
Efficiency and returns. Let's give that a 6 out of 10. ROE is healthy, NFO margins improved for the year, but HR Owen's declining margin shows that persistent pressure. Our previous dive kind of implicitly confirmed this mix, noting NFO's inherently higher margins were key.
Right, liquidity and debt.
Liquidity and leverage scores a 7 out of 10. The company is showing strong deleveraging, paying down debt, and interest cover looks robust. However, that full-year operating cash flow decrease from FY 2024 does temper this score slightly. Our last dive noted strong 9-month cash flow. So while still good, it's perhaps a slight step back on the cash generation front for the full year.
Okay, growth outlook.
Growth outlook is a 4 out of 10. Management says cautiously optimistic, but analysts are forecasting that net profit decline for FY 2026. And there's that heavy reliance on unpredictable jackpot cycles. Our previous deep dive explicitly questioned the sustainability of Q3's performance because of that unpredictable jackpot cycle. This low score kind of confirms those earlier doubts.
Makes sense. Dividends.
Dividend policy and sustainability will assign a 6 out of 10. Total DPS and the payout ratio were clearly down this year. Now, analysts do forecast a recovery, but this year's reduction is a signal worth noting. Our last deep dive highlighted the lower 9-month dividends, suggesting a possible shift in capital allocation focus, which we now see played out in the full-year numbers.
Okay, the moat.
Competitive strength, the economic moat, gets a 6 out of 10. Consistent with the analyst score, they have the license monopoly, the jackpot factor. But these strengths are seriously undermined by that massive RM9 billion illegal gaming market and the regulatory risks. Our previous dive explicitly mentioned the 610 score and really emphasized how alarmingly large that illegal market is. So consistency there.
And finally, risks.
Finally, risk profile, considering the red flags and challenges, that's a 4 out of 10. The sharp Q4 profitability drop, those significant impairment charges, the high Q4 tax rate, the decreased full-year operating cash flow, those are all explicit red flags from this year's results, plus all the general NFO and HR Owen specific risks we discussed. Again, our previous dive touched on many of these persistent risks like illegal gaming, jackpot volatility, Forex, confirming this relatively low score for risk profile.
So yeah, the scorecard really brings into focus the volatility, doesn't it? Especially that Q4 hit, which wasn't as apparent when we just looked at Q3 earlier. It paints a much more, well, complete picture of SBTU's operational landscape now.
Exactly. Q3 looks strong in isolation. But the full year, and particularly that Q4 performance, truly revealed the inherent sensitivities and the significant risks at play. It makes that 6 out of 10 score feel quite fitting for a company that has strong fundamentals but is definitely operating in a complex and challenging environment. Outro.
Well, what a fascinating deep dive into Sports Toto's latest numbers. It's a really powerful reminder, isn't it, that even within the same company, different parts can tell very different stories, and quarterly results can shift, sometimes quite dramatically.
Indeed. That outperformance driven by the jackpot cycle in Q3. You contrast that with the sharp profitability plunge in Q4 and then layer on the persistent challenges like that massive illegal gaming market.
Yeah.
It really highlights the complexities here. Management seems to have a clear strategy for navigating it all, but yeah, the path ahead won't be without its hurdles.
So maybe the provocative thought to leave you, our listener, with is this. Given that sharp decline we saw in Q4 profitability and the significant red flags we've identified, can Sports Toto successfully navigate these pressures? Can they really deliver on that cautiously optimistic outlook for the next 5 years, especially when they're up against that staggering RM9 billion illegal market?
That is the multi-billion ringgit question, isn't it? The strategies they have around cost management for HR Owen, trying to get more special draws for NFO, those are positive steps. But the efficacy of actually combating illegal betting and just managing the broader economic headwinds, that remains absolutely crucial.
Absolutely. Definitely something for you to ponder as you reflect on this deep dive. Thanks so much for joining us. And please don't forget to like this video, leave a comment with your thoughts, and subscribe to the Deep Dive channel for more in-depth analysis. We'll see you next time.